3.7%. That's Vancouver's vacancy rate right now. And before you say, okay, so what? Let me put that into perspective. Rents are down, listings are up, and landlords are still struggling to fill units. How does this happen? That's exactly what we're going to unpack today. 2 years ago, that number was 1.6%. 3.7% is the highest vacancy rate this region has seen since 1988. That's 38 years ago. The tightest rental market in Vancouver just opened up faster than anyone expected. And if you own a downtown condo as an investment or you're thinking about buying one, the math has changed in a way that most people haven't fully processed yet. Let me tell you about a situation I've been seeing more and more of. An investor bought a one-bedroom condo downtown Vancouver in 2022. Made total sense at the time. Vacancy was near zero. Rents were climbing every year. The plan was simple: buy it, rent it out, let the tenant cover most of the mortgage while the asset appreciated. This is the classic Vancouver playbook. Here's what happened instead. By mid 2024, rents peaked and started falling. Then a wave of new supply hit the market. Then the short term rental ban pushed thousands of former Airbnb units into long-term rental pool. And suddenly, a unit that was supposed to rent for $3,000 a month sat vacant for 6 weeks before renting at $2,400 per month. 600 less per month than the plan assumed. That doesn't sound catastrophic on its own, but when you run the actual carrying costs, mortgage, strata, property tax, and realize they were already running a monthly loss at $3,000, now they're over 1,000 in the hole every single month. And I'm not sharing this to create panic. I'm sharing it because whether you're a buyer, a seller, or an investor, this shift changes the map in ways that are going to matter for the next few years. And here's what the headlines are missing. Falling rents aren't just good news for renters. They're quietly reshaping who sells, who holds, and what downtown condos are actually worth right now. If you own a rental property, this isn't easy to hear. If you're a buyer trying to figure out whether now is the right time, I know the noise isn't helping either. So let's cut through it together. By the end of this video, you're going to understand exactly what broke the rental market, what the real numbers look like on a downtown unit, and what it means for your decisions. So with all that out of the way, let's get into it. Here's what you have to understand about how this market worked for the last decade. Vancouver's rental market was essentially broken, but in the other direction. Not enough units, vacancy near zero, rents going in one direction, and that's up. Landlords held all the leverage. If your lease was up, your landlord could raise the rent by 10 or 20%, and there was 10 people in line the next day. The reality shaped how investors thought about downtown condos for years. Buy one, rent it out. Even if you're slightly cash flow negative each month, your tenant is subsidizing your asset. Wait for appreciation. That was the Vancouver investor thesis. And it drove enormous demand for studios, one bedrooms with dens downtown for a long time. And it just worked. Then something changed, and it changed faster than most investors expected. The rental market that felt unbreakable started to crack in late 2024. And that data we're sitting with right now in 2026 would have seemed impossible, imaginable 3 years ago. Vacancy from 1.6% to 3.7%, unheard of. Rents down 6 to 7% year over year, down closer to 15 to 20% from the absolute peak depending on unit type. And the units getting hit the hardest are the studios and true one bedrooms, which are exactly the product types that are making up the bulk of downtown investor inventory. The obvious question is why? What exactly happened? Three supply shocks hit the market simultaneously. The first was new purpose-built rental supply. BC just recorded 21,000 new purpose-built rental completions in a single year. That's a 56% increase over the prior year. The city of Vancouver alone delivered 2,300 new rental units, the highest volume the city has seen in 40 years. All of that entered the rental pool at the same time. The second was the short-term rental ban. The province's Airbnb restrictions forced thousands of units that were operating as short-term rentals back into the long-term rental market. Units that were charging $200 a night are now competing with $2,400 a month tenants. That's a massive shift in availability supply almost overnight. The third was presale completions converting to rentals. Investors who bought presales years ago expecting to flip on completion found themselves in a resale market that didn't want their product. So instead of selling into a soft market, many chose to rent, adding even more supply to a market that was already dealing with the first two shocks. Three supply waves all arriving at the same time into a market showing demand softness at the entry level. This is why the vacancy rate just hit a 38-year high. Let me show you what the math actually looks like on a real downtown unit. 690 square feet, one bedroom plus den, Yaletown, recent sale price of 620,000. If you bought that unit as a rental property today, here's what your carrying costs actually look like. Mortgage, and I want to be specific here because this matters. The best insured mortgage right now is around 3.89%, but the rate is for owner occupied purchases under $1 million. If you're buying a rental property, your rate is higher, around, say, 4.84%. That distinction doesn't get talked about enough. It's the difference between a rate that sounds manageable and one that fundamentally breaks the math. At 4.84%, on a $496,000 mortgage over 25 years, that's approximately $2,840 per month. Add strata at $500 a month, property tax at roughly $172 per month, and a landlord insurance cost of almost $50 a month that people almost always forget. Total hard carrying costs approximately $3,560 per month. Now let's look at rent. At the peak of Vancouver's rental market in mid 2024, a well-presented one-bedroom plus den in Yaletown was getting about 3,000 to say 3,150 per month. Even at peak rent, this investor was already running at a monthly loss of roughly $500. Today, that same unit is renting for say 2,400 to $2,600 per month, depending on condition and timing. That monthly loss just went from $500 to over $1,000 per month. Now, a sophisticated investor will push back on that number. They'll say about 850 of that mortgage payment every month is going towards principal. So, from a net worth perspective, that actual loss is closer to $160 per month. And that's a fair point. But here's the reality. From a cash in, cash out perspective, from a bank account perspective, you are writing a check for roughly $12,000 a year just to keep the property alive. That is the $1,000 monthly subsidiary that buyers are running in their heads when they are looking at these units, and that's why they're walking away. If you don't believe me, look at the days on market data for downtown one bedrooms right now. Units sitting for 100 days, 175 days, some pushing past 200 days. Those aren't overpriced listings in bad buildings. Those are normal units where the investor buyer looked at the math, ran the numbers, and left. Now, I also want to give you the other side of this because it's important. I have a client who bought in Yaletown back in 2023. He's had the same tenant since day one. Rent started at $2,350. Under the BC annual rent increase cap, it's now at $2,500. The tenant is happy, no intention of leaving, and my client isn't stressed. Why is he okay when others aren't? Because he bought before the market peaked at a price point that gives him some cushion. His tenant relationship means no vacancy, no turnover costs, no releasing into a soft market. The investors who are in real trouble are the ones who bought in 2021, 2022 at elevated prices with peak rent assumptions baked into their numbers. The math was thin then, and now it just doesn't work. So, what does this all mean for the resale market? Well, a few things worth watching closely. First, inventory is rising. Downtown Vancouver active listings went from around 760 a year ago to over 1,000 today, a 33% increase. Part of that is investors who can no longer absorb the monthly loss or in choosing to sell into a buyer's market. More supply without a corresponding increase in buyers puts downward pressure on prices. Second, the entry level is the most exposed. Studios and true one bedrooms are sitting longest. Stats show downtown overall at a 13% sales ratio. Balanced market territory. But inside that number, the investor grade small unit product is where the pressure is most concentrated. And here's why. These units have lost the two biggest buyer pools at the same time. Investors who can't make the math work and end users, real people who want to live in the unit, are stretching for layouts with a den or a second bedroom because that's what their lives actually need. A true one bedroom under 550 square feet is competing for a very narrow slice of the market right now. Third, prices are adjusting. The benchmark condo in Vancouver West is down 6.8% year over year. In some pockets, the West End is down over 10%, Point Grey closer to 12. The correction is more pronounced. If you're a buyer, this is the environment where you have negotiating power that hasn't existed for years. Sellers who are losing money every month are motivated, and that changes the conversation at the offer table. If you're an investor holding a unit that's cash flow negative, you need to run your numbers honestly. And the question isn't whether the market recovers eventually. The question is how many months of $1,000 plus losses your balance sheet can absorb while you wait. That's not a market call. That's personal finance. And if you're thinking about selling, buyers right now are informed and disciplined. They're doing their homework. Presentation and pricing discipline matter more in this environment than they have in years. Overpriced listings aren't just sitting, they're becoming stigmatized and forgotten. Before I wrap up, I want to hear from you. If you own a rental unit in Vancouver right now, what's your situation? Are you holding, thinking about selling, still comfortable with where you're at? Drop it in the comments. These conversations are generally useful for me and for those watching and trying to make the same decisions. Here's the one thing I want you to take away. Falling rents in Vancouver aren't just good news for renters. They are a fundamental shift in the investment math that has been supporting downtown condo prices for the better part of a decade. And that shift has consequences for buyers, sellers, and investors that are going to play out for the next 12 to 24 months. If you're trying to figure out what this means for your specific situation, whether that's a unit you own, a building you're looking at, or a question about timing, that's exactly the conversation I have with clients. No pitch, no pressure, just a straight look at the numbers. The link to book a call is in the description below. If this kind of content is useful to you, consider subscribing. It means the world to me. And subscribing means you'll see the next one. I put one of these out every week. Thanks for watching, and we'll see you in the next one.